Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnina with NinjaTrader on this glorious Wednesday morning, April 5th, 2023, start of the second quarter. We have a great presentation today, a great guest today. Before we go too far, I do want to remind everybody, trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. Although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital, money I could afford to lose, doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. Stress is a big deal to human beings. We make bad decisions when we're under stress. So be in a good spot. Remember, micro contracts could be your friends. Easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. And feel free to participate in the chat on the ninjatrader.com website. Finally, I want to remind you again, none of this should be construed as trade or investment advice, and past performance not indicative of future results. Thanks for being here, everybody. We have back again at See the Futures, we have Blue Putnam, Chief Economist and Managing Director of the CME Group. Good morning, Blue.
Good morning. Glad to be back.
I'm glad you're here. We have some important, though, housekeeping stuff to talk about right off the bat. What's that? Anthony Crowley was talking about a tennis match, supposedly, between you and him. He's still bitter about it, by the way.
I know. I zinged one past him, and it changed our relationships.
I'll drink cappuccino with him. I'm not playing tennis with him, though. I don't want to get him mad at me.
No, that was a fun little game we had down in Florida.
I don't know how long ago it was, but he still brought it up. I mean, he's still bothering him. But anyway. Well, thanks for coming back. And we're still seeing this huge, divergence between, Fed funds expectations from the market point of view, and then from the FOMC and Board of Governors. And that's kind of what we want to generally talk about today, and figure out why is there this divergence and what's going to be the answer.
Well, it's going to be tricky. The Fed and all of the speakers are on the same page, and they've been making the point that the Fed is data dependent. Data dependency, by the way, means you're looking backwards. Not my recommended way to drive a car, but at any rate, what does data dependence really mean? Let's look at just a couple of charts really quickly. The Fed has three jobs: financial system stability. So what are we seeing on the data there? So let's look at the regional bank index. This is the stock prices of regional banks. They took a dive, but they've stabilized. But by taking a dive, what the market's telling us is that these banks are going to have to revisit their business model because they've lost a lot of deposits. That doesn't mean their loans are bad. Their loans are good, but their loan to deposit ratio isn't where they'd like it. So they're going to be very careful with extending credit because they don't have as much room as they had. So if we look at the next slide, we'll see where the money went.
So Blue, I'm sorry. Yeah. You triggered a question in my mind. When you say they lost deposits, where did the deposits go?
That's the next slide. They went two places. Right. They went to big banks, really big banks, but they also went to money market funds. And this is the chart of the assets under management of money market funds. So you can see during the pandemic, we provided $5 trillion of stimulus, and an awful lot of that went into safety, money market funds. And then when we had the banking crisis, another bunch of money, not quite $1 trillion, less than $1 trillion, but a lot of money went to money market funds. So, but the other part of the money from regional banks migrated to the very, very top 3, 4, 5 largest banks. So that just means the regional banks don't have as many assets. They don't have as many deposits. And so their business model is going to be constrained, regardless of who their clients are. Okay, this is all over the country. And what this means is that the data we're going to get is when any of these somewhat larger regional banks, top 10, top 15, provide their earnings, they're going to give us forward guidance, and we're going to be listening to that over the next couple of weeks. But there won't be any real data. It'll just be guidance. So that's the financial system data we have, which is not much. Now let's the next job of the Fed is encourage full employment. And this one is checked off. This one's fine. I look at weekly new unemployment insurance claims because it's weekly data. I want to get the fastest data I can. That's the best data I know. And this is good data. And we're averaging around 200,000 new unemployment insurance claims a week. That is below the pre-pandemic trend. When this number moves, let me tell you, it moves fast. So if it ticks up to 225, that's noise. If it ticks up to 250, we're headed for trouble. And when it gets to 300, we were already in trouble and we just got the email late. So I'm watching this one carefully, but right now it doesn't tell us anything. Now, we've heard a lot of layoffs from big tech companies, some Wall Street companies. Layoffs, if they come with severance pay, you're not allowed to get unemployment insurance and severance pay. So you're going to have to wait. So this number probably doesn't move till June, July, or August. What I'm really saying here, there's no info between now and the next Fed meeting.
By the way, it seems like a lot of the announced cuts that we've seen over the last, 2-3 months from the bigger companies anyway, are starting to actually implement those cuts today. So there seems to be a little bit of a lag.
Oh, yeah. Turn to the next slide. There's definitely a lag. First, you announce your cuts, then you make your cuts. But it's way easier to pull a job opening than to cut somebody. And so this chart shows the job openings compared to the number of unemployed. And we are seeing a little bit of a downtick in job openings, but they're still way, way above the number of unemployed. Unfortunately, there's a big mismatch here. A great many of these job openings are in the hospitality sector, hotels, restaurants, travel, things like that, not the highest paying of jobs. And the people getting laid off are engineers, Wall Street people, it's a little more white collar layoffs this time. So we'll see what happens to this ratio. But it's still quite elevated, and it suggests that people can still move if they want to. So that's employment. Let's go to the next slide and talk about inflation. This is the job the Fed's really focused on right now. The Fed has started looking at the CPI without the shelter. Shelter is the sticky thing. It's but we've already hit the housing market pretty hard, but the price of housing is not in the CPI. That's an asset. And so, it's going to be a while before rent and what we call ownership rental comes down. So, but CPI ex shelter went to 10.6 and it's down just a hair below 5%. It's coming down. We're making a lot of progress. I do believe the progress from here on out will be slow, but we have made a lot of progress. So where does that leave the Fed? Next slide. Oh, I'm sorry. I stuck this oil one in here because we had a little incident with OPEC cutting production by 1 million barrels over the weekend. That was a surprise to me, by the way. I didn't get that one right. But notice that it didn't take it out of the trading range. It just took it from the low end to the high end of the trading range. We're still in that $67 to $82 on WTI. So, and by the way, when OPEC cuts production, not everybody cuts. And Russia wasn't asked to reduce production from what they're already doing. So the Saudis are the ones that have discipline. I'm not going to attribute much discipline to anybody else. So just be careful with ramping that cut into a $100 oil forecast. We might get to $100 in the next 3 years, but not right now. So anyway, let's go to the Fed dilemma. Next slide. So here's the dilemma. The Fed has guided us that's the blue line at the top. They're going to keep rates high for longer. And then maybe they can start cutting in 2024 if we've made some progress on inflation. So that's the guidance. And Jay Powell, at the end of the last press conference, he was so clear. He said, cutting rates is not in our base case. Now, they can have other cases. They can have like, what's the worst case scenario, things like that. But the base case is they're not planning on it. He was also pretty clear that they could raise rates, but they don't actually have to. The futures market is totally opposite. This is a snapshot from this morning. As you can see, the futures market, federal funds futures, rates have already peaked, and they're going to start going down in the second half of the year and keep going down. So big debate out there. And this is really a debate about whether we have a recession or not. And for the Fed, the question is, when does policy get sufficiently restrictive? So the word sufficiently is Jay Powell's word. Restrictive is something I know about. I don't know if it's going to be sufficiently restrictive, but I do know a little bit about what's restrictive. So let's look at the next slide. We have the Treasury yield curve is inverted. It's been inverted for 6 or 7 months. Typically, you wouldn't get a recession till 12 to 18 months, so we're still early on that account. But this one is screaming restrictive, and it's been doing that. So if you believe in the yield curve, you've already done enough. And, you've already broke something. The banking system's had a challenge. So let's look at another measure of restricted. Next slide. This is the PCE core inflation rate. This is the Fed's favorite measure. It does include shelter. It's been pretty sticky, but it is coming down. It's at 4.6% for February and coming down. And Fed funds are 4.75 to 5%. So we now have Fed funds above the core inflation rate. That's considered restrictive. This doesn't look as restrictive as the inverted yield curve, but if you kind of draw that inflation line ticking down a couple of percent more over the next 3 months, it gets to be a little more restrictive. So that's, those are my slides. Where I come down on all this is that the Fed isn't going to get any data between now and May 2nd that's going to help them make a decision on May 2nd. And when I say any data, the next unemployment data is all about what happened on March 12th, way too soon. The next inflation data is what happened in mid-March, way too soon. The next unemployment insurance claims data, that comes every week. But as we've already said, it's probably not going to start ticking up until June or July. So I don't think the Fed's going to get any news other than the earnings reports from banks and bank guidance, and I don't think that'll be enough. So the Fed's, driving on data dependency, and we're a little weak on the data right now. So that's my story. Jim, I know you got some questions.
Well, now I have a whole bunch of I have a whole bunch of new questions. No, if we could keep this chart in particular up for a second. So we have a whole bunch of new questions now. The this chart here. So we're seeing PCE core inflation, which is by all accounts is important, right? We've seen a huge escalation in 2021. I'm just looking at the chart, relative to the slope of the line. Is it typical to see an equal and opposite kind of breakdown, or is it going to kind of slowly? What's typical? Slowly move down or quickly move down on the PC?
It really isn't a typical answer. In the 60s and 70s, the inflation rate was taking the stairway up, and it took the stairway back down. This one, it's taking the elevator up and the stairway down. But we had a very special pandemic. A lot of people analyze the pandemic with traditional economic models, and I'm pretty sure they're all going to be wrong. This was just such a special event. I look at it as more like an analogy with a health scare. The economy got a health scare in March of 2020, and we were admitted to the intensive care unit, and we were given $5 trillion of fiscal stimulus, backed up by $5 trillion of monetary stimulus. We felt incredibly good. We got let out of the hospital, and then we had side effects. The biggest side effects was the inflation surge, which you see right there. We were given a lot of money to spend while the economy was not producing as much as it used to, let alone more. So that's economics 101. We get the inflation surge. But then as the inflation surge comes, we got to go back to see the doctor. And the doctor says, oh, you got to have high interest rates. Well, they have side effects too. So we've had a banking system challenge. And we have more side effects coming from the fiscal policy rollback in the second half. Student loans have to be, make payments again. The Medicare rolls are going to get People have to re-enroll. We're probably going to lose 5 to 10 million people on Medicaid. Sorry, Medicaid. We have to see what the banking challenges are going to do. But I do consider that a tightening of credit conditions for the economy. So there are a lot of headwinds in the second half of the year that we don't even know about yet. Anyway, I'm not answering your question, but I think core inflation is going to come down very, very slowly. It won't come down like it went up.
So and thank you for the slide, Mission Control. So part of that equation too is, or how big of how much weight was there to the conflict, Ukraine and Russia, amidst all this other stuff?
Actually, not that much. The supply chain problems were early on in the pandemic. We couldn't spend money on services, so we spent them on goods, and we overwhelmed the supply chain because due to the fiscal monetary policy, we had tons of money to spend. We put some of it in money market funds, as we showed earlier, and then we spent a bunch. And the supply chain problems were really, being resolved when Ukraine hit. Ukraine was all about oil and wheat. Oil from Russia and natural gas from Russia and wheat from the Ukraine and Russia. And so those were very specific events. Pretty quickly after the start of the war, we understood that Russia was going to be able to sell their oil to India and China and a few other countries. So oil prices went back down. So very temporary impact.
Okay. So let's go back to the oil observation. So we had the SVB Credit Suisse situation. Oil broke below 72 into the 60s, and then after that, dust settled, started to rally back up into the range that you described. My range is like 72 to 82, something like that. And we were heading back in that direction, and then we had this announcement that shocked everybody, right? And we gapped up in oil. That we were going in that direction anyway, weren't we?
We were. Oil was rising a little bit because the recession fears triggered by the banking crisis were abating. So oil was coming back a little bit. Then OPEC made their move, and WTI, U.S. crude oil, got to 81. So it stayed in your trading range. It just went from the bottom to the top.
Right. And the cuts were, quote unquote, voluntary, to your point.
Yeah, voluntary kind of means you may or may not do them.
Right. So we'll see if we get to settle back in the middle of the range or not. I don't know personally, but I have my eyes on that because it's going to impact probably a lot of different stuff. So that's part of the equation as well. We also saw jolts yesterday go below a 10 million number for job openings. Is that just a random number, or is that important?
Well, people like round numbers. So for some people, 10 million was an important number. For me, it was a pretty small move. I just look at the number of unemployed people and the number of job openings, and it's still a huge gap compared to history. I don't think there was any particular news there. But if we do get more layoff announcements, we will expect job openings to be pulled. But as I pointed out earlier, a lot of these job openings are in the hospitality sector, and they're not in the sectors that are announcing layoffs. So there's a disconnect there. I wouldn't use that data too much. By the way, it's seriously lagged. It's lagged an extra month compared to the regular jobs data.
Okay. All right. Well, yeah, like 5 weeks, right? Or no?
Yeah. I mean, we just got at the end of March, we got the February data, but it's a long lag.
Got it.
That's the thing with data dependency. When the lags get longer on the data is not as valuable. So that's why I look at the weekly unemployment claims.
Well, let's talk about then GDP now at the Atlanta Fed. They try to predict going forward, right? And they have a range and they have an average line. Be careful. All that stuff.
The Atlanta Fed is not predictive. They wouldn't use that word. They're going to thank me for this, by the way. They take the data that has come out as of today and track it against what the GDP might have done through today in the quarter. So they're kind of, it is a GDP now, but it's not a GDP future.
Okay. Or that, but it's more contemporary than some of the other data we get, right?
Yes, it is because it contains all of the pieces of data that they think matter for GDP, but it's still only released data. So, retail sales are very important. 2/3 of the economy is, spending, consumer spending. And so that's important, but that's still a month behind. Um, so, inventories are critical. That may be a little further behind. The trade balance can be very important for GDP, and that's 2 months behind. So they're very data dependent too. And by the way, if you look at the GDP now, it's in the last couple of weeks, it's been over 3% and below 2%. It's not exactly a stable number.
Okay. Oh, that's great information to know. I downloaded the app. I look at it all the time. It's easy to do, right? Just click a button. It's on your phone. It's magic. We didn't have that magic 20 years ago.
No, we didn't. And it's on my phone too. I look at it all the time, but be very careful with it. It's only based on the data that has come out today. So it's all lagged, and none of that is March data.
Okay, that's my question. That's really good. That's really good information. I appreciate that. Let's talk about the 2-year to 10-year yield curve. I was looking at the CME Group's micro yield contracts, and it looked like now we're inverted maybe 38 basis points, give or take, this morning. That's a tremendous move down from we were 100 basis points not too long ago.
That's right. The 2-year is essentially 2 years of daily data combined into one number. And so the big thing that happened in the last couple of weeks is not that we thought the rates were going to go much higher, but we thought the 2-year is pricing in that Fed funds view that rates are going to start getting cut in the second half of the year. So if you're looking at how inverted the yield curve is, the 2 versus 10s isn't your number anymore. You really just need to look at the Fed funds rate today against the 10s. And that gives you the degree of inversion because the 2-year embeds that forecast that rates are going to be cut. And it's a disconnect with the Fed saying, no, we're not doing that.
So, but the Fed funds futures versus the tens, when will that go back to normal? Is there a trajectory we're on right now, or is it just all just 100% related to what FOMC does going forward?
Yeah, normal is a fiction of the economists. It doesn't exist. Normal is just what you think your past history was telling you, but not necessarily somebody else's or a longer view of history or thing. The Fed funds rate in and of itself is between what the Fed tells us they're going to do and what the market thinks the data might tell them to do. And that doesn't go back to any kind of typical value. But what I can tell you is I believe a tremendous amount of the uncertainty will get reduced by September, because then we'll have a much better answer as to have we impacted the labor market or not, and is inflation still coming down or not. And if inflation is down to, say, 4% year over year on the core, and the unemployment rate has ticked up a couple, then, rates have peaked. The Fed's going to be happy with that. But if you get another scenario, well, who knows?
Right. So when you look at the Fed funds futures table, the tool, the CME Group's Fed funds tool, it's an awesome matrix, right? You can see that matrix. I'm wondering if the FOMC members are looking at that and factoring in what the market thinks they should do in addition to what they think they should do.
Oh, yes. Only casual evidence, but we're pretty sure that a lot of people look at these probabilities of what they're doing. And it concerns the Fed that the market doesn't appreciate their guidance. I'm not sure what the right adjective there is, but that's something where the Fed is trying to provide some guidance and the market's saying, well, we got different scenarios, which is what the market does. The Fed's in the business of running a central bank, and the market's in the business of clearing price discovery.
Right. Well, I'll stop short of saying that, the CME Group is basically driving monetary policy for the United States. So we won't go that far.
No, we certainly won't. It's a market participant. There's a buyer and a seller out there on every trade. And so, and these aren't, we talk about Fed funds futures as being predictive, but they're not particularly good at predicting. What they are is telling you what the cost of managing your risk is. And, CME is really in the risk management business. And so this is the cost of risk management, which can change as conditions change.
Yeah, what surprises me though, really, is it's tracking right now at the end of December, the last meeting, I think December 13th, 2023, highest probabilities is about 3.75 to 4.0 right now. And that number's been sitting there for a little bit of time right now. It hasn't moved much.
That's right, and that's why I think we'll have a little more clarity by Labor Day, because either we're going to see the economy is weakened a little more than the Fed thinks, or we're going to see the economy being weak, and then the Fed would make a move. So, one of these views, we have two views here: Fed's view and the Fed funds futures view, and only one of them is going to be right. But we're not going to know that by the next Fed meeting, and probably even the meeting after that. But we'll get some clarity over the summer, and then we'll be worried about something else.
Yeah, well, if the Fed is data dependent, as I'm sure they are, I'm sure they're not just saying that. We know the market's data dependent, and so maybe these two things will meet in the middle somewhere. Get tighter and tighter in presenting less uncertainty.
Yeah, I'm not so sure they're going to meet in the middle. To me, it's more of a one side's going to be right and the other side's going to be wrong, and they're not going to meet in the middle. The middle is the where you price the probability of a recession versus no recession, and that's just going to change. And in the middle of all this, sorry to introduce another topic when time is short, but we could have a debt ceiling crisis in June, July, and August, probably July and August. This would be the totally wrong time for that to develop. But the Fed has to factor that in too. They won't talk about that. They don't want to be involved in that. But nonetheless, it's out there, and we'll all have to think about it as to what might happen.
Yeah, history tells us anything. They'll resolve it at the last minute. Everything will be, fine.
Yeah, that's what history tells us. But every now and then, history throws us a curveball. We're more polarized politically than we've been in a long, long time. I mean, I have to go back like to 1836 and President Andrew Jackson when he killed off the central bank of the day. And then we didn't even have a central bank in the U.S. for the next 70 years. That was pretty polarized times. But at any rate, it's going to be a very volatile summer for all of these reasons.
For sure. So a couple last second questions. One, is there, for the traders that are listening to us today, going forward, what are maybe some of the more important economic releases we should focus on?
Well, I am focused on, as in economic data, I'm focused on the weekly unemployment insurance claims. When they start to move, they're going to be my signal. Now, the noise level on that data is easily 10 to 15,000. So 200 to 215, I don't care. Back down to 190, I don't care. When it's over 225, it's got my attention, and it's moving toward the recession indicator. So you got to, kind of have a noise level that you're comfortable with on this data. We have something called spurious specificity in economics. So some economists like to be exceedingly specific. I have a serious problem with that because I'm quite aware of the limitations of my own forecasting. So I like big number handles. So that's the data I look at from economics, but we're going to really be listening to the forward guidance coming from the banking sector in this corporate earnings season. What are the bankers telling us? And I care a little bit about what the big bankers telling us, but I really want to hear from the middle-sized bankers because they're the ones that have been hurt. And what are they thinking? What are they going to tell us? And I don't normally even listen to them.
Yeah, well, Jamie Dimon yesterday said interest rates are extraordinarily important. They are the cosmology constant, or the mathematical certainty that affect all things economic. So what he's saying there is Fed's going to set Fed funds, and that's what's going to change directions either way. That's how I interpret it.
Yeah, I think that was a good interpretation, but he's he really wanted to spread the blame a little bit. So he kind of broadened the it's a well watched report that he does each year. So he had a lot to say. So I recommend people taking a read. But the big banks are talking about policy. I want to know what the smaller, middle-sized banks are going to do with their lending.
Okay, got it.
That's
Last
where the
question, real quick.
jobs are.
Last question, real quick. I know we're up against time right now, but I'm going to throw it out anyway. This is really for my own education. Why does the FOMC have a 25 basis point target instead of a 50 basis point target or a 35 basis point target?
Well, they used to not have a target. Back in the days of Greenspan, they just had a number, but it was in 25 basis point increments. But every now and then they did 50. Typically, the Fed they started doing this target stuff over the last, after the 2008 crisis, and they got into like giving a range. But prior to 2008, the Great Recession, Great Financial Panic, we didn't even pay interest on banking reserves. So when we did all this QE, we had to set an interest rate on reserves so that the money stayed at the Fed and didn't go do something it wasn't supposed to do. So that they adopted this target range, but they keep the Fed funds rate in the middle of that target range based on the interest they pay on reserves.
That makes sense. Got it. All right. Thanks for that. I really appreciate your time today. Learned a lot for sure, as usual with you. Hopefully, you're going to be back soon. So in a little while, we'll see you again.
I think we're back after the FOMC meeting or somewhere in there.
Yeah, you might be with Tom Schneider. You and Tom, I think, are doing that. I'm fortunate enough to go to the Kentucky Derby that week.
Wow, nice.
Yeah, should be fun. But anyway, I need a vacation anyway, so I'm leaving. In any event, thanks again, Blue. We greatly appreciate you being here.
Thank you.
And everybody else, please, thank you for coming. Appreciate you being with us today at See the Futures. And remember, most important message of the day, please be safe out there and be good to each other. Thank you.